Okay, in today's video, we're going to talk about Forex risk-reward ratio. And when you enter a Forex trade, you want to make a certain number of pips, and you're willing to risk so many pips, and that is your risk versus your reward. So I think Forex traders need to increase their expectations, and I will show you how, not only how to calculate risk-reward ratio, but how to change it dramatically trade after trade. So how do you calculate risk reward ratio? It's calculated two ways. Here's an example. If you start a trade, a buy trade, and with a 30 pip stop and you expect to make 120 pips, your risk reward ratio, your risk is in the numerator and your reward is in the denominator. So technically it's 0.25, but a lot of times people will say 4-to-1 risk reward ratio, which is, it's actually the reverse. 1 divided by 0.25. So if I say a risk reward ratio of 4, it just basically means I expect to make 4 pips for each pip that I risk. You're trying to make 120 pips and you're willing to risk 30 on an initial stop until you move your stop to break even. So I've seen it calculated both ways, and just remember that depending on where you're looking on the internet, you'll see it calculated two different ways. It's either can be 0.25 or 4-to-1, which is just 1 divided by 4. Okay, here's where we get started. What is a good risk reward ratio? Okay, this is what's going on in the Forex industry now is pretty bad. There's many articles on risk reward ratio, and they are telling you that you should try to make 1.5 to 2 pips for each pip you risk. It's silly, it's ridiculous, and Forex traders should never settle for less than really around 4-to-1, where you're trying to make 4 pips for each one you lose. And I'm going to show you different ways to get 10 to 20-to-1 in this article. So I think Forex traders need to completely change their expectation. If you see any articles about risk reward ratio telling you to try to make 2 pips for each one you risk, forget that article, move on, and look at what we have here. We're going to show you some great ways to do this. Okay, is a negative risk to reward ratio possible? The answer is yes. A lot of Forex traders, they're using technical indicators and they're scalping the Euro USD on the small time frames. They're trying to make 10 pips, and they either have a 30 pip stop order, which is upside down. This is negative. This is a negative number. Negative pips they're trying to make with a negative reward. This is very wrong, but it's very prevalent, and it's because people are using technical indicators. They're scalping the Euro USD over and over again with the really horrible technical indicators, the standard technical indicators, the Fibonacci's and the RSI's and all the junk that's out there. So let's talk about the right way to do it, trade after trade. And we have 3 rules we're going to give you for minimizing your risk and maximizing your reward on every trade. When you buy or sell a pair, you want to get into positive pips quickly. I mean, just within a few minutes if possible. And here's how you can do it. So this is strategy number 1. Only enter trades that have strong momentum on entry. So if you want to sell the pound Aussie dollar or the pound Swiss, probably even the pound USD, look, the pound is weak. This is when you sell the pound pairs. And of course, the Euro pound is the cross currency, is the pound, the base currency on these pairs. So this one would be going up. So look at these signals. The pound is weak. You sell the pound against the Swiss franc, okay? Folks, this is not a 20 pip drop or a 30 pip drop. This is a 300 pip drop in one trading session, okay? Now your risk reward ratio is going to be a lot higher when you do it this way. Look at these signals. The British pound is weak. You're selling it after it started moving, maybe the first breakout point here, and it just continues lower. This is a 300 pip drop in one trading session. If you use an initial stop of 30 pips, This is a 10-to-1 or 0.1 risk reward ratio, and you're not scalping the Euro USD time after time with zero upside, just horrible risk reward characteristics. If it starts dropping and you get into positive pips, you can move your stop order to break even, and then you have zero risk on the trade. You can scale out lots, and then if the pair is trending down, if the pound Swiss is trending down on the bigger time frames, or if the pound is just weak across the board on the time frames, on the bigger time frames, then you have more upside with zero risk. This is zero risk trading here, okay? Now that's how you manage your risk reward ratio. This is just one way of doing it, okay? Which to have strong momentum using this great tool called the Forex Heatmap. Now let's move on to the second way to reduce risk and increase potential reward, okay, on every trade entries. Look at this chart. This is the Swiss franc against the yen, but look, it's the larger time frame. It's the MN time frame. It's the largest time frame on most platforms. So you see your breakout point here around 118.0, about 118.80. Look at the potential reward here on a support and resistance basis. 118.80. This pair has a chance to move up to the 129 to 131 area, which is the next major resistance. So it breaks out here. This is 1,000 to 1,200 pips of upside potential. Forex traders do not trade this way, but they need to start doing it, and they need to change the way they do things. So definitely you want to stick with the higher time frames, like the H4 time frame or larger, all the way up to the MN time frames. Look for great entry signals and breakouts using great tools like this, and all of a sudden you're starting to build a very low risk, almost zero risk, a trading system. Okay, and here's risk reward strategy number 3. We call it the 30-minute rule. If you get into a trade and you're not setting your stop to break even after about 30 minutes, in some cases it could be a little bit more, maybe about 45 minutes, you have to exit the trade, almost in all cases. Now, most people, when they enter a trade, if you sell this pound Swiss, it's got to drop. It has to drop quickly, and it has to drop a lot, and so you can get your stop to break even. So if you're using a system like this, you can use the 30-minute rule, and what you're trying to do here is you're trying to have large gains, and then the rest of your trade should be a combination of small wins and losses. You're trying to avoid any big losses, and you can do this if you stick to the higher time frames, and if you're not at a break-even stop within 30 minutes, you have to get out of the trade. Okay, so now what's going to happen if you combine all 3 of these strategies? Well, here's what's going to happen. You're going to have strong momentum on entry. You're going to move your stop to break even within 30 minutes, and you should have profitable trades. You should have occasionally some very large profitable trades like the one we showed you here, okay? And if you're trading, let's say the Swiss yen gives you a strong buy signal using the Forex Heatmap and it breaks out, you can set your stop to break even and you have a chance to make 1,000 pips or more on one trade entry. Stick with the higher time frames. So always combine all 3 strategies on every entry, all 3 of the strategies. Okay, now here's some more ideas, obviously, but you always trade with a stop. Here's some other risk reward strategies. Trading in the direction of the trend, using the higher time frame, moving your stop to break even, and if possible, enter the trade at the beginning of the trend cycle. So if you see a strong move starting and you're near the beginning of the cycle, whether if it's on the bigger time frames or the intraday cycle, get in at the beginning and then you can take the difference. Trading at the beginning of the trend cycle is very important too for reducing your risk and increasing your potential reward. So if you have great tools like the Forex Heatmap, you don't need to do things like standing orders. A lot of people use, I'm going to call them standing orders or resting orders or buy stops, sell stops. A lot of traders do this, trying to trade around the news, but you don't have to do this. It's unnecessary risk. You're adding more risk. Wait until the news comes out. If you're a news trader, wait till the news comes out. Wait till you have a rock solid signal from the Forex Heatmap and you're trading in the direction of the trend, and then you can go ahead and enter the trade. So buy stops and sell stops, we would eliminate them from your trading program. So here's our thoughts. Currently, Forex traders, they just accept way too much risk. Trying to make 2 pips for each pip you risk it's not worth it. You shouldn't even be trading. But if you can get risk reward ratios starting around 3 to 4 and up to 20 to 30 on the higher time frames, you've got a much better program, and we're giving you specific examples of using the higher time frames. Strong entry system with momentum on entry in one direction, so you don't have to wait and wait and wait to move your stop to break even. And all of these tips, what it'll do is it'll minimize your risk, but it'll maximize the number of pips you can get. So check out all these techniques and start using them, and these great tools we have on forexearlywarning.com.